Hello there, this is Matt Curfman from the Richmond Brothers with an early August 2021 edition of Matt's Minutes. Thank you so much for tuning in. Thought as we got into the last month of summer here that we just provide a couple of updates just from the last few weeks. There's been quite a few changes just in the world, I would suggest. And so I thought I would start with what are we seeing as some of the concerns or some of the headlines that maybe you all are seeing with reading, watching the news, seeing things online, things of that nature. So first and foremost, obviously, we're seeing a Delta variant of the COVID virus multiplying rather rapidly throughout communities, states, and even the country. And so while it does seem and appear to be less deadly, it still is a factor. And the one thing that kind of ripples from that could be the idea of fear that could basically tie into the market. So wanted to kind of keep an eye on that. We certainly are trying to do everything we can to stay cautious and help keep ourselves and our team and employees protected. And we hope you're all doing the same. The other thing we're seeing in the headlines is talk still about inflation, potential talk about higher taxes, which we have talked about for at least a year or two, if not more now, with respect to continued higher spending out of the government. Doesn't seem to matter which party's in the White House. We just have massive deficits. And so at some point, we do anticipate we will see higher taxes. So I want to talk a little bit about that. Also, the Federal Reserve strategy, and are they going to keep kind of the cheap money policy going? What I mean by that is keeping interest rates low. While interest rates are really low in the economy, it provides for cheaper mortgages, cheaper borrowing, continues to basically allow for the flow of spending. If rates start to go up, consumers generally don't spend as much because mortgage rates, instead of 3%, maybe they're 6%, or car loan or credit cards, anything that basically keeps consumer spending alive. There's been a lot of pent-up demand from lockdowns from 2020. And it seems like people are trying to get out and about and spend some of those built up reserves, as well as people have a higher savings level than they have in a number of years. So those are really the main things. The one thing as we head into the fall that we think is possible, we have gone through the earnings season, or at least a good chunk of it, and by and large, numbers are pretty good, which supports over time continued growth in just the general markets and the economy. That said, I wouldn't be shocked, and we wouldn't be shocked if sometime this fall the market had a bit of a pullback or a correction. If you remember from previous Matt's Minutes, a correction is just defined as the market falling back about 10% or greater from its recent high. And so that is certainly a possibility. And so with that in mind, we've had a lot of great feedback in talking individually with all of you, when you're talking with your advisor, when we're doing any planning, even looking at proposals for changes, using your risk score. And so if you all remember, the Riskalyze score is a range of 1 to 99. 1 would be the safest money, 99 would be the most aggressive, and every individual investment, whether it be a stock, a bond, a mutual fund, an exchange-traded fund, cash in the bank, cash in your portfolio, fixed annuities, all has a risk score based on volatility. If you had everything basically in the S&P 500 or the broad market, that's typically going to be about a risk 75. A lot of individual stocks are anywhere from 80 up to 99. And the bond market generally is going to be about a risk 25. So why that's important and why I want to bring this up is if we were to go through a correction in the market, we're not suggesting that we need to try to time the market or make dramatic changes. So a strategy we can continue to use if you're a newer client, we're dollar cost averaging into the markets over a period of months. And that's a real good strategy to buy through volatility. If you're already an existing client and you have a percentage of your portfolio with market exposure, we want to just keep talking to you about those tolerance ranges, almost like the goalpost. So if you had a risk 45 portfolio and the market had a really big swing down, what would you expect to experience? And so we're going to continue to talk on a individual basis on the risk score. If you happen to watch this video and you haven't had this discussion yet, reach out to questions@richmondbrothers.com and let us know that you would be interested in looking at your risk score to see if it matches where your tolerance is right now. The other thing with strategy as we look forward, we talked about higher taxes and a possible correction. Something to keep on the radar. There's always strategies to take advantage of uneven or unbalanced things. And so if you're doing Roth conversions, we've had a lot of great success in doing that with all of you so far. It's a strategy that if prices come down and you're going to hold those assets a long time, it might be worth considering if it's in an IRA, converting some to a Roth. You're choosing to pay tax now, and I'm not saying this is a blanket strategy that applies to everyone. It's just an idea that can help move through volatility and take advantage of swings in prices. And then just continuing to take advantage of being aware of your risk score. So we are here for you. We're going to continue to monitor through this. If you have any questions, don't hesitate to reach out. questions@richmondbrothers.com is our main corporate email. We appreciate you. We hope you all stay safe and healthy and can enjoy the last month or month and a half of summer before fall sets in. Thank you so much for tuning in.